Hello everybody, Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. Today we're going to talk about looking for companies that can provide you growth at a reasonable price, often referred to as GARP. And I'm going to talk a little bit about some of the things that you can look for so that you can actually find growth at a reasonable price in a logical and what I'll call practical manner. So what I'm going to do, I went and did some screening and I came up with 5 what I consider to be fairly valued growth stocks that you can buy or research. Now, these are research candidates. I haven't researched all of these thoroughly yet, but I'm going to be. I'm going to be adding these to my total return portfolio list, or at least the ones that I end up deciding on. So let's go ahead and take a look at a small portfolio of 5 stocks that I put together that provide you the opportunity to do some research where you're looking for rates of return in excess of 20% a year. That's what I consider a true growth stock. So let's go into FastGraphs and let's look at these 5 research candidates. So I put together a little portfolio view here for you. The companies I'm going to look at are Autoliv, H.B. Fuller Company, Oshkosh Corp, Sonoco Products, and Verint Systems. And you'll notice that I've got some diversity here. So I'm looking at automotive parts, specialty chemicals, construction machinery and heavy transportation, paper and plastic packaging, and then application software. So I've got a little bit of everything here. Now, one of the things, if I'm looking for growth, it would make sense that I want to invest in companies or look for companies that have the ability to grow in the future. And so these are all mid to small cap companies. And one thing I like about mid to small cap companies is they typically have a lot of room for growth. Okay, now I also looked for companies that primarily had double digit or close to it potential estimated future growth rates. And as you'll notice that all these companies meet that bill. Sonoco Products is actually one of the slowest growing stocks, but yet what you'll find out here when I get into it is it has the second highest potential annualized rate of return, and that's where valuation comes into play. So we're going to go through these one at a time. Now these are smaller or mid-capitalized companies, okay, so they're not your big monsters, but again, they have the ability to grow. So let's start by looking at Autoliv. Now what I want you to notice about this company, its historical growth rate over a long period of time has been about 7%. Over the last 10 years, that's increased to about 10%. And that even going through COVID when they had a couple of down years. Okay, so if I run this as a 6-year view, I've got 16% growth. My forecasting calculator is expecting 14% growth going forward. Now let me talk about this a little bit. I want to look at the history of the company. And it should be very clear that operating results are what drive stock prices, whether they're going down, whether they're rising, whether they're going flat, going down, or rising. This company is expected to be rising in the future. So when I'm looking at the more recent years, we've had pretty strong growth. We had one real strong year in 2023, but then that was followed by a weak year in 2024, but we're expecting decent growth going forward. All right, now, when you're looking for growth at a reasonable price, it's the growth of the business that's going to generate the rate of return for you. And if you can buy that growth at a discount, like you can here with Autoliv now, then what happens is when you look at your forecasting, you're looking at a pretty widely followed company. There are 23 analysts forecasting 12.5% growth for this fiscal year end, over 14% growth for next year, and over 14% for the following year. And that gives us an average of 14.22% over the next 2.5 years. If that were to trade at simply a 15 PE, then I would have the opportunity to make a 24% annualized rate of return if I bought the stock now. Now that rate of return comes from 14% growth, almost a 3% dividend yield. So this could even be looked at for those who are looking for income. And we'll talk about that a little bit more here in a minute. But then I'm also getting the PE expanding from the current 13 up to a 15 PE, which is a very reasonable expectation. The normal multiple in this company has been higher than that. If it were to achieve its normal multiple of 16, then you'd be looking at something closer to 30% annualized rate of return. Now, these are what-if scenarios calculating the future. The key here is the growth rate. The valuation shows an earnings yield of 7.72%, and again, a very attractive dividend yield of almost 3%. The company has modest debt of only 31.87% debt to capital. And when I look at the history of this company, if I look at it from the long run, it's got a little bit of a spotty dividend record. That's something that if you're a dividend investor, you'd want to take into consideration. It is somewhat cyclical. But let's go ahead and get into the company real quickly and look at what the company does. Okay? If I look at the company's solutions, they have airbags, seatbelts, steering wheels, inflators and initiators, textiles and webbing, motorcycles and bikes, pedestrian protection, and so on. Okay, so it is in the automotive industry, as you can see, but it sells products to the big manufacturers. I think that's the key point. And the company has put together some really pretty strong growth here recently coming out of COVID, and it's expected to have good growth going forward. Now, with all these companies, as I'm looking, I would go into fiscal fitness. For one thing I'd like to do, and I want to immediately look at margins. Okay, this company's net margin has been pretty steady, but it doesn't have a high margin. Okay, but it's been pretty steady in all aspects. The returns on assets are strong. The returns on equity are strong and been rising. And the returns on invested capital are strong, and they've been rising in recent years. So I consider those all good signs. So what this leads me to is the position that I'm willing to look at this company a little deeper to see if I am buying a bargain here that gives me good growth potential. And the fact that it's only a $9 billion market cap with very modest debt gives me the opportunity to look a little deeper. Now, since it is a dividend-paying stock, I will look at operating cash flow, and I like to see the operating cash flow covering the dividend, which it does. I looked free cash flow to equity, and here we have some red flags. There are times when the free cash flow to equity doesn't cover the dividend, which can explain why we see some of these dividend cuts here. So that's something I would want to research deeper. But the key is I would go in and learn as much as I could about this company and why the analysts expect this growth going forward for this company. And again, there are 17 analysts, and the analysts have been raising their estimates here in the more recent times. 6 months ago, the estimate for 2025 was 783. The most recent estimate is 842, which is where the analysts have settled at for this year end, which obviously we've got a little over a quarter and a half to go. So I like Autoliv. It's one that I think is worthy of spending more time learning about. The next stock on the list in the portfolio is H.B. Fuller. So let's look at this company from the long term. This company is actually a little more consistent than what we saw with Autoliv. So that's one of the first things I like. It's had a very consistent growth rate, averaging over 10%. It has an earnings yield over 7%, again, which I like. A modest dividend yield, higher than the market, but about 1.6%. It's a $3 billion plus market cap, and it does have about 50% debt. Okay, looking at the company from a valuation point of view, you can see how the stock price really tracks earnings. Now, a lot of people don't understand this. This is a 15 PE ratio on this orange line. And that becomes a valuation reference. And if you look at this, you can see that anytime the stock price gets below the orange line, that becomes a really excellent entry point. And when the stock is above the orange line, that becomes a less than stellar entry point. Okay, that's true of all companies. So this company is now trading at a blended PE of 14, giving it that 7% earnings yield. But the reason I like this stock is analysts expect it to grow at almost 16% a year. Now, there aren't that many analysts following this relatively small $3.14 billion market cap, but they are increasing their estimates on the company, and I like to see that, so they're getting more positive about the company. Again, I would go into fiscal fitness. I would look at things like margins and try to evaluate. Now, one thing I noticed the last couple of years, the margins have been relatively low, their net margins. So that's, again, another red flag that I'd want to examine more closely. And I'd also want to ask and answer the question, why do analysts are so positive about growth going forward, where they see such strong growth going forward? Once again, I can go into the website. Now, one of the things that people comment on all the time in my videos is I don't talk about the company or the macroeconomics and so on. Well, I do. I designed fast graphs so that I could go into these companies and learn about them. In the terms of these short videos, I don't do all that. I leave it up to you to learn. But you can see that this is a company that serves the aerospace market, appliances, automotive aftermarket, concrete, e-commerce, packaging, electric vehicles, electronics, and so on. It offers these following technologies and these following applications. So again, I would spend some time studying what this company actually does. And I do want you to notice that it was overvalued for all these years here. Now that it's come into fair value, and again, this would be the time to look. The whole most important principle about investing is buy low and sell high. So I've got an opportunity here to buy it. Now, can it go lower? Sure. And I don't know where the bottom is going to be, but this is where I would start. This is one I would put on my radar and start watching and look for a real good entry point. And if I did build a position today and the stock dropped, I'd be willing to add more to it, ceteris paribus, meaning all things remaining equal. The next stock I've got here is Oshkosh, and it's construction, machinery, and heavy equipment. So again, this real quickly, let's go into the company and look at some of their brands and innovation. They have electric vehicles in what I'll call industrial markets. They have intelligent products, they call it, to get the job done. And again, I would go in through each of these things. There's mobility, where they talk about things that help move things around. So I'd want to learn more about Oshkosh. The company only has 18% debt. It is a small cap. It's giving me an earnings yield of over 8%. And again, a modest dividend yield. But it is historically very cyclical. But again, price tracks that cyclicality. Looking at the analysts, we're expecting a down year this year, which could explain why the stock is down. But we're looking at 13% growth going forward. That gives us a chance to make 24% annualized. If I look at the normal multiple's been about 15. So that still gives me this idea of making somewhere just under 25% a year analyzed if I bought this and held it. But I do want to make that point. I'm looking at the business generating me the return, not the bouncing stock price. I'm going to focus and try to decide whether the business gives me the opportunity to participate in long-term growth. And again, it's got modest debt, and it's even got an investment-grade credit rating. The next is Sonoco Products. It's a stock that's had 2 negative years of earnings, which I think really explains the negative movement in the stock price over the last 2.5, almost 3 years here. All right, but that's where the bargain's created, because analysts now are expecting a turnaround. We're expecting actually pretty strong growth this year, over 20%, followed by 7.5% in subsequent years. So that gives us just under a 10% average, but this is where you can make the 44% growth, because we're looking at a blended PE that's trading at almost half what its fair value would indicate. At blended PE of 8, when you've got a business that should very rightly be trading at a 15 PE. If you look at it historically, it's very common for it to trade at a 15 PE or higher. It's only because of these negative couple years, but the negative years, I think, were also a result. Now, I'd want to examine this further. We had this 83% increase. But if I actually drew a line from here to here, really the earnings have been steady. It's just this peak earnings is what caused these down earnings, or what contributed to them anyway. The forecasting calculator, again, 9.5%, but I've got the potential for the PE to go from 8 to 15, plus a dividend yield of almost over 4.5%. That leads all to a total rate of return potential of over 44% a year. I think that's worth spending some more time trying to figure out what this company really does. And again, you can go into the company's website and learn a lot more about the company's products and what they do, and then try to determine whether or not there's actual growth in these products. They've got paper containers, rigid paper containers, metal packaging, and industrial packaging, and you can examine each of these items for their potential in the marketplace. The next company on the list is Verint Systems, Inc. This is an application software company. Software can be very volatile, as you can see by this long-term chart, but yet the business is what drives the returns ultimately. Okay, this hasn't been a real fast-growing company, but recent times we're getting a little better growth than we have, and the company's forecast to grow at double-digit rates for the next couple of years. That leads us to the possibility of getting a rate of return of over 50%. Again, having the PE ratio double. Now, this company doesn't pay a dividend. It's a pure growth story. But you're buying it, here's the example of buying growth at a very reasonable price. Now, I do want to make something clear here, that you're looking at a stock, if I look at it historically and look at it from a long-term perspective, it's easily or routinely traded at 15 times earnings or higher. And the fundamentals are not bad enough right now for it to be trading at such a low valuation. So I'd want to know, why is the market undervaluing this stock so much right now? Again, it has almost no debt. It's an interesting little company, and it's heavily involved and focused on AI with some really strong customers in AI. So this is one that if you're a long-term investor, and that's the key. Long-term means you buy the business and you let the business make you the money by growing the business and not worrying about the stock price. That's why the orange line is so critically important on these companies. So there you have the 5 companies that are growth at a reasonable price opportunities. I haven't decided whether I'll be investing in any of these or not, or putting these on my total return, but I've got all of my total return list now, and I'm going to continue to do my own research and due diligence. So I thought I'd share that with you. Those of you who are looking for growth at a reasonable price and like to do it yourself, you might want to take a look at these 5 companies. Anyway, this has been Chuck Carnevale, co-founder of Fastgraphs, bringing you 5 potential research candidates for growth at a reasonable price. They all look very interesting to me, and I'm looking forward to learning more about each of these companies. And if you are, then give me a like, subscribe to the channel if you haven't subscribed already, and take a look at Fastgraphs. What a powerful tool and a great way to evaluate common stocks, whether it's growth stocks, dividend stocks, or whatever. Anyway, thanks for watching, and we'll talk to you again real soon.